JEPQ JEPQ. Is it going to be better than JEPI? Should you rush to buy JEPQ? Now, what are we talking about? We're talking about the JPMorgan Nasdaq Equity Premium Income ETF. JEPI's little brother? Big brother? Don't know. We're going to do a quick overview of this. Since it's so new, we really don't have a whole lot to talk about. This fund is typically or basically just like JEPI. Okay. The difference is the index that the fund picks its stocks from. That's really the only difference. Okay. But we're going to do an overview of it real quick. We'll talk about the ELN a little bit. I'll share you an article from Investopedia that explains how the ELNs work. We'll talk about the volatility. We'll talk about the dividend, and I'll give you my thoughts. So let's dig in. Now, JEPQ, from the famous JP Morgan that brought out JEPI that became so famous, right now, trading at a price of $49.18, expense ratio of 0.35, same thing as JEPI. What are the basics of it? It's designed to provide current income while maintaining prospects for capital appreciation. Now, that's what I want to but drive home. Maintaining prospects. Okay. Everybody always wants their cake and eat it too. JEPI has done a very good job at kind of doing that. But the design of the fund is really to provide current income. That is first and foremost. So how does it do it? It generates income through a combination of selling options and investing in U.S. large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. Seeks to deliver a significant portion, so just a portion of the returns associated with the NASDAQ 100 index with less volatility. So it doesn't say you're going to get growth like the NASDAQ 100 on top of the current income. It says you're just going to get a portion. Now, it does say significant. What does that mean? I don't know. But it does seek to deliver a significant portion. So it constructs a long equity portfolio through a proprietary data science-driven investment approach designed to drive portfolio allocations while maximizing risk-adjusted expected returns. So what they're trying to do is they're basically trying to lower the beta. And when they talk about beta, they're talking about basically the volatility of the fund, how much it participates in drawdowns. They're trying to limit the participation in the drawdown. Now, portfolio manager is Hamilton Reiner. He's the same person that runs JEPI. So I would imagine a very similar, I don't want to say performance, because JEPI and JEPQ are very, very different. Okay. JEPQ, based on the NASDAQ 100, is going to be extremely heavy in the tech sector, right? So S&P 500 is going to be, there's quite a bit of overlap here too. I didn't even talk about that, but there's a bit of overlap here. So we'll look at real quick the summary. We already talked about the expense ratio. So this is an actively managed fund. They're going to create an actively managed portfolio of equity securities comprised significantly of those included in the fund's primary benchmark, which is the NASDAQ 100. And number two, through equity-linked notes selling call options with exposure to the benchmark. The resulting fund is designed to provide investors with performance that captures, now they say, a majority of the returns associated with the benchmark while exposing investors to lower volatility than the benchmark and also providing incremental income. So there's another key word there is returns associated, majority of the returns associated. Now, what does the majority mean, right? 51%? Because that would be majority over, over 49. So I kind of wish it would call that out and kind of have a benchmark for it, but they don't. The fund invests at least 80% of its assets in equity securities. Assets mean net assets plus the amount of borrowings for investment purposes. In calculating the 80% policy, the fund's equity investments will include common stocks and ELNs. So what is an ELN? Let's take a look at it. Now here's a good one here, okay? Because I know a lot of us are very short-sighted, but this is a good paragraph to read about it. The fund seeks a lower volatility level than the benchmark. Volatility is one way to measure risk and refers to the variability of the fund's or the market's returns. If the fund is successful in providing lower volatility, then the value of the fund's portfolio will fluctuate less than the benchmark. Here's key: over a full market cycle, typically a 3 to 5 year time horizon. So a lot of times you'll see people, well, it underperformed this. And you're only talking about the past 6 months, right? They're targeting a full market cycle, typically 3 to 5 years long. So, a lot of us, I'm guilty of it too, are very short-sighted, and we probably need to look a little bit further out. So real quick, let's take a look at, where did I go? Here we go. Let's take a look at real quick at the holdings. We'll look at the portfolio. Top 10 are going to be very heavy in the Nasdaq 100. You got Apple, almost 10% of the portfolio. Microsoft, 9%. Google, 6.5%. Amazon, 5%. And these here, the NDX 1, 2, 3, and 4, those are the equity link notes. And it looks like about 17.2% roughly in equity link notes. You have 3.5% in Tesla, 3% in Facebook, and I believe I read somewhere, number of holdings 81. So, what is that? I didn't even count it up. 10, 20, 30, 40, 50, like 60% of the portfolio is in the top 10 holdings. So I didn't even compare it to JEPI, but I don't believe it's that concentrated in the top 10. So I would expect JEPQ to be a bit more volatile in price action, but that also will mean volatility to the upside as well. Okay. I think this was a perfect time for this fund to come out with the NASDAQ down almost 22% or whatever it is year to date. I think it's a great timing that this fund comes out. Real quick, I want to share with you an Investopedia article explaining equity link notes, and we'll read through this as quickly as possible. So what is an equity link note? An equity link note is an investment product that combines a fixed income investment with additional potential returns that are tied to the performance of equities. Equity link notes are usually structured to return the initial investment with a variable interest portion that depends on the performance of the linked equity. ELNs can be structured in many different ways, but the vanilla version works like a strip bond combined with a call option on a specific security, a basket of securities, or an index like the S&P 500 or Dow Jones, or in this case, the NASDAQ 100. In the case of a note linked to an equity index, the security would typically be called an equity index linked note. Understanding them. Equity linked notes provide a way for investors to protect their capital while also getting the potential for an above average return compared to regular bonds. In theory, the upside potential for returns in an equity linked note is unlimited, whereas the downside risk is capped. So, in a sense, these are fixed income notes, and that's how they can lower the volatility of the portfolio. So here's a simplest form example of how ELNs work. A $1,000 5-year equity linked note, it's just an example, could be structured to use $800 of that $1,000 to buy a 5-year strip bond with a 4.5% yield to maturity, and then invest and reinvest the other $200 in call options for the S&P 500 over the 5-year life of the note. There is a chance that the options will expire worthless, in which case the investor gets back the $1,000 initially put in. If, however, the options appreciate in value with the S&P 500, those returns are added to the $1,000 that will eventually be returned to the investor on top of the 4.5% yield. So that's just basic, stripped down how a basic ELN works. Now, how are these ELNs structured that JP Morgan are into? Nobody really knows. So that's kind of like the mystery of JEPI and JEPQ. So like I said, dividend wise, what's it going to be as far as a yield? I suspect it's going to be very similar to JEPI. Although I would expect a higher yield. I would like to have a higher yield as an investor in JEPQ, just for the fact that it's going to be almost a guarantee going to be more volatile. Okay, so for that, I would like to be rewarded with more income. Will that play out that way? I don't know. But JEPI has definitely outperformed, right? I believe, they should be running about a 6 or 7% yield, and they've been beating that like crazy. I would expect in normal times that JEPI will come back down to a normal 6-7% yield, and a lot somewhere in that 30 to 40 cent range. I know that's going to make a lot of people mad, but it is what it is. But like I said, it came out on May 2nd. We will see what the first dividend's going to be on June 2nd, I believe. I got the calendar here. It's on the same schedule as JEPI. Here we have JEPQ right there. So income is going to be June. The ex-dividend date is going to be June 1st. And it's going to pay June 6th. So JEPI and JEPQ are going to pay on those dates. It'd be interesting to see what that pays out. Now, I wanted to look real quick at the volatility, and this is very short-sighted because JEPQ has only been out for a few days, right? But this kind of shows it, right? And this is not totally fair because it's not heavily traded. JEPQ is not heavily traded, so the bid spreads are a little wonky. But if you look at the peak on Wednesday, May 4th, and you look at how it closed on Friday, it lost 4.07% from peak to trough, just from Wednesday. Now, what did JEPI do? Same time period from peak to trough, Wednesday to close of Friday, lost 2.6%. So if that's a picture of the long term, yes, you are going to be exposed to a lot more volatility in JEPQ as opposed to JEPI. Am I buying JEPQ? I don't know. Well, I shouldn't say I don't know. I lied. I bought 4 shares. Okay, I just wanted to put it in there. I don't know if it makes sense to own both, because you're going to have quite a bit of overlap in those top 10 holdings, in the holdings altogether, really. Because if we look at, now this isn't representative, but if we look at, whoops, I got the wrong one. We look at the ETF overlap, and let's take a look at JEPI and compare it to QQQ. 101 holdings, 20% of JEPI's holdings are also in QQQ. So you're going to have a little bit of overlap. You might be a little heavyweight in some things. This is probably not even in here. JEPQ is probably not even in this database yet. No, it's not even in the database yet. But I don't, like I said with a lot of the other ones, there's no rush. I don't think there's a rush. If you if you could stand the volatility, and you haven't bought into JEPI or JEPQ or any of them, it could probably be okay to start a position here. With the Nasdaq being down almost over 20%. What is the Nasdaq down year to date? Year to date down 23%. I think it's a great time that JPMorgan came out with this, to give you probably a little less. Here's the thing, okay? JEPQ is going to be less volatile than QQQ, but more volatile than JEPI. And they're gonna, I'm gonna take a wild guess and say they're gonna pay about the same yield, though I would like JEPQ to pay a little bit more than JEPI for the volatility inconvenience, if you will. So that's all I got. JEPQ. Keep it on your watch list. I got 4 shares. I'm watching it daily, and we'll see if I keep buying it or not. Hope you guys enjoyed. You guys have a great week. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.